Welcome to the Knakal News Network. The Knakal News Network is brought to you by Cushman & Wakefield, New York's #1 building sales firm.
Hi, I'm John Hagenman, Sales Team Manager for Team Knakal at Cushman & Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of Investment Sales in New York for Cushman & Wakefield. Last week we talked about the state of the current investment sales market and the first quarter results, but we didn't really get into some of the factors that are driving the market. So today I was hoping we could talk about interest rates.
The federal funds rate has been below 25 basis points for over 6.5 years. And for the past 4 years, that rate has been less than 16 basis points. So you really can't get any lower than that. Rates certainly can't go down. So we do anticipate that rates are going to go up at some point. And a lot of people say that when rates go up, that's going to be a very negative thing for commercial real estate.
Rates go up, people can afford to pay less for property. So wouldn't it be a negative impact on the market?
If rates go up simply because our money supply is 400% of what it was 6 years ago, that's a bad thing. If rates go up because the Fed's balance sheet has more than tripled in the past 6 years, that's a bad thing. But the fact is that if rates go up because we have real tangible traction in the economy. GDP growth has only averaged 2.25% since the recovery began. And it's important to note that with GDP growth at 2% or less, we feel like we're in a recession, even if we're not technically in a recession by the definition that economists use.
Okay, but it seems like hiring has done a lot better recently, Bob.
I think it's important to look at the job picture on a macro basis. And that is, during the recession, we lost 8.4 million jobs. Since the recovery began, we've added over 11.5 million jobs, so we're more than 3 million jobs ahead of where we were going into the recession. But our population has grown by nearly 20 million people since the recession began. So we're still 7-8 million jobs short of where we need to be to have that same feel-good feeling that we had in 2007. So if you look at job creation not being really where it needs to be, GDP growth not being where it needs to be, those are troubling statistics and probably reasons why the Fed is keeping rates low.
So Bob, you said if rates go up for the right reason, it's a good thing. Can you expand on that a little bit?
Sure. Well, I got off track a bit, but if GDP growth becomes stronger, if it's at 3 or 4%, if job creation starts to show good momentum and the numbers start to get to 300,000, 400,000 jobs created a month, and rates go up, that's a good thing because, yes, if rates go up, cap rates will go up. But if the economy really has that kind of momentum, net operating income in buildings will go up also. So even with a higher cap rate, the additional NOI caused by a good economy is going to drive prices further up. So it's not necessarily a bad thing that interest rates rise for the commercial real estate sector. In summary, interest rates are an important factor impacting the investment sales market. Rates are likely to rise in the short to midterm, but why they rise is much more important than if they rise. Given the right combination of factors, commercial real estate will still do extraordinarily well even if rates do increase.
Thank you for joining us today. Tune in next week for another installment on the Knakal News Network.